Retirement is a time to enjoy the fruits of your labor, but it can also bring into focus how much tax you're actually paying. Now, different types of income that you receive are going to be taxed differently, and understanding these nuances can help you and your advisor plan more effectively. Let's consider an example. You're 66 years old, retired, and living in Ontario. You have a base income of $8,560 of old age security and $9,600 of CPP for a total base income of $18,160. You're curious to know the effects of additional income being added to your tax return, specifically if you target a taxable income of $90,997. Why that specific amount? Well, it's at that level that your old age security benefit would start being clawed back if you made any extra money. To reach this target, we need an additional $72,837 of income. Now, let's see what would be the effect of withdrawing funds from an RRSP. So as we know, when we make withdrawals from an RRSP, it is fully taxable and added to your income. So if we withdrew this amount from the RRSP, our total income would be $90,997 and our total tax bill would be $19,306. What if instead of withdrawing funds from the RRSP, we withdrew them from a RRIF instead? So again, we withdraw the same amount, the $72,837. Our total income is still $90,997, but now our total tax bill is only $18,912, so slightly less. Now, why is that? Well, whenever you make a withdrawal from your RRIF after the age of 65, you can qualify for the pension credit, which slightly reduces your tax bill. So the RRIF in this case is going to be a little bit more efficient than the RRSP. Next, let's consider triggering a capital gain in your non-registered account for, again, the same amount, $72,837. Now, when you realize a capital gain, only half of it is added to your taxable income. So you would only include $36,419 to your income, resulting in a total taxable income of $54,579 and a tax bill of $7,368. This makes capital gains more tax efficient than RRSPs and RRIF withdrawals. Although it's worth noting that under the new rules that are coming into effect, any capital gains in excess of $250,000 or within a corporation, you're going to have to include 66% of that gain, but that doesn't apply to this situation. Now let's look at eligible dividends. These are dividends paid by Canadian corporations from income tax at the higher corporate tax rates. Now suppose you receive, again, the same amount, $72,837 in eligible dividends in your non-registered account. Now these dividends are going to be grossed up by 38% before being added to your taxable income. So this brings your total income up to $118,675. However, the eligible dividend allows you to claim the dividend tax credit, which significantly reduces your tax bill to $3,855. But there's a catch. The OAS clawback is based on your total taxable income, and because of the gross up, now our income exceeds the clawback threshold. So as a result, you'd lose out on $4,152 of OAS benefit, bringing your combined taxes and clawback to $8,007. So this is going to be slightly less efficient than triggering a capital gain. If you receive the $72,837 from another source, like interest from a GIC or a foreign dividend in a non-registered account, then this entire amount would need to be added to your taxable income. And again, similar to an RSP withdrawal, you'd be left with a tax bill of $19,306. Finally, if you withdrew the $72,837 from a tax-free savings account, there would be no taxes on that withdrawal. You would still need to add your OAS and CPP income to your tax return, but it is low enough in this case that no taxes would be payable. Additionally, because your income is so low by using the TFSA, you may even qualify for the Guaranteed Income Supplement on top of your old age security. Understanding how different types of income are taxed in retirement can help you make strategic decisions when it comes to reducing your tax burden and increasing your after-tax income. However, keep in mind that you want to take a look at your tax bill throughout your whole retirement. Just because a TFSA withdrawal incurs no tax today doesn't make it the right strategy when we consider that you're eventually going to have to pay taxes on those other sources of income. For all your retirement needs, check us out at transcanadawealthmanagement.com.